We'll now move on to reading number 40 of the CFA curriculum that will teach us the concepts of private real estate investing. Now, generally speaking, basic forms of real estate investments include either private or public. Private can further be subcategorized as debt and equity investments. Investments is when we buy mortgages or when we invest in mortgages, that is, we give somebody a home loan. If the value of real estate goes up, the credit spread on that loan will also reduce, or the probability of default will reduce if the value of the house goes up, because even if it defaults, you will be able to recover the value from the house, and hence the value of this mortgage will go up. Direct equity investing in private real estate is easier to understand. So you can buy the whole house, be the owner, invest through partnerships or other forms of commingled funds wherein some people pool in their money, and with that money they together buy real estate with the help of a fund manager. Public investments can be through mortgage-backed securities. So these are listed securities normally, or securities created from an underlying pool of mortgages. The risk return profile will be similar to residential or commercial mortgages. Public equity investments take form of real estate investment trusts and real estate operating companies. So these are companies that are in the business of real estate. For example, DLF or Unitech in India. Real estate investment trusts are like mutual funds, only they have a restriction of investing in income producing properties, and they have to repatriate, or rather they have to give 90% of their income back to the investors as dividends. We'll study more about the characteristics of REITs in the coming slides. So what are the characteristics of any real estate investment? First, the investments are quite heterogeneous. The same apartment will be valued very differently depending on its location, depending on the amenities, depending on 100 other things. High unit value generally. Active management is needed to see the tenant, collect the rent, so on and so forth. High transaction costs. The brokerages involved in concluding a real estate transaction are generally higher than what is needed in other asset classes or other securities. Depreciation and desirability can affect the value of the property. Cost and availability of debt capital is very important because normally these will tend to be leveraged investments. Lack of liquidity is another characteristic of real estate investments. So if you want to sell it, it may not be that easy to sell, or you'll have to again initiate the process of hiring a broker and finding a buyer. Difficulty in determining the market price, as normally these assets will not trade on an exchange and the liquidity will be low. Now there are various classifications of real estate properties. Residential properties generally refer to single family homes and apartments. They can sometimes be purchased with the intent to produce income, that is rental income. So they sometimes can be considered commercial, especially if you are buying to rent it out, then it is more comparable to a commercial investment. But generally these are single family homes and apartments. Non-residential real estate includes office spaces, industrial warehouses, retail, hospitality, hotels, etc., which are generally purchased for income and commercial exploitation. Farmland, timberland are also examples of land or real estate that produce agricultural commodities or other commodities, and they produce a saleable commodity which drives the source of the returns, so you can lease it out. And there is also a potential for appreciation as the value of timber or the value of cotton or whatever the produce that you are growing increases, the value of the land can also increase. Primary reasons for investing in real estate include current income from lease rentals that are generally derived, the potential for capital appreciation dependent on demand and supply. Real estate acts as a good inflation hedge. Inflation happens because the prices of commodities go up. A lot of commodities go in the construction of real estate: cement, steel, labor, land. If inflation happens, the value of all these things go up, and hence the value of your real estate also tends to go up. Real estate does have the potential for diversification benefits, as we'll see in more detail at level 3, that including real estate can increase the Sharpe ratio of your portfolio. It has low correlation with debt and equity or traditional investments. The real estate can often also offer significant tax benefits, as a lot of the expenses are tax deductible, and the government also gives tax benefits for purchasing houses and purchasing assets. There is a possibility of further reducing tax because of high depreciation expense that you can show if you have a real estate property. And in many countries, real estate investment trusts don't pay any taxes at all. So these investments definitely can provide significant tax benefits. So there are some reasons why you should invest in real estate in your portfolio. Principal risks are many. If the business conditions change, that is the macroeconomy, the stock market, etc., will all have an impact on real estate as well. If you've invested in a new property, it may be 2 to 3 years by the time the property gets delivered. And in that 2 to 3 years span, it's quite possible that the conditions change. What area was desirable now is not desirable 2 to 3 years later. Cost and availability of capital. So if debt becomes more expensive, value of real estate again goes down, because they're always, or the demand will go down because leverage is tougher to obtain. If inflation is unexpected, it can negatively impact the value of your asset, because your lease rentals would have locked in some expected inflation. So you said, okay, 5% increase every year or 10% increase every year because you were expecting some kind of inflation. If inflation is higher than your expectation, then that is not built into your lease rentals, and hence the present value of your income may go down. Demographic factors, the tastes of people, the kind of, whether they are more old people, more young people, will all drive the value of real estate. Lack of liquidity is a big risk. Environmental issues are a big risk. So where the apartment or the commercial building is located, what are the regulations around that area, if it is in a forest zone or if it is in an industrial zone, and what are the environmental regulations, will all affect the value of your real estate. Availability of information is normally low, and bigger problem is that of information asymmetry. Unlike stock markets, where all information has to be disclosed on regular exchanges, so everybody has the information more or less, in real estate the buyer and the seller can have very different informations, and there are processes of approvals, etc., which you need to know and you may not have full information on at the time you are buying or selling. Management expertise is needed to manage the tenants and to make sure that the building is occupied and the maintenance is done at regular intervals. Leverage additionally enhances the risk. So leverage can increase your returns if the return is good, but it will doubly reduce your returns also if the return is bad. Other factors also affect the value of your real estate. For example, the design of the building, the amenities that are being offered, the neighborhood in which it is located, the economic activity that starts around that neighborhood, the regulations around the neighborhood, the other buildings that are coming up, can all affect the value of your property or your real estate. So in a portfolio, we've generally seen that the risk return profile is in between that of stocks and bonds. So it's lesser risk than stocks and bonds, or rather lesser risk than stocks, slightly higher than risk than bonds, but lesser return than stocks and slightly higher return than bonds. Real estate has both bond-like and stock-like characteristics. The lease rentals that we get from the real estate are very bond-like. However, once the lease expires or if the tenant vacates, then at what level the new lease will be signed? Will it be at a higher level? Will it be at a lower level? Will all depend on the economy, the neighborhood, the incomes of the people, the population, the demographics, all of which are similar factors that affect equity prices as well, or equity valuations as well. So it has characteristics of both bonds and stocks, and leverage is an important factor in investing in real estate. So normally these are high ticket investments which you normally take a loan and invest in. So if you've taken a loan, we all understand that leverage will add to your returns if the returns are good. It will further take away from your returns if the returns are bad. Commercial property itself can be of various types. So office buildings have their return dependent on the growth of the economy, and when calculating the value of the office, be sure that you're looking at the gross lease or the net lease. So gross is before any maintenance and other expenditures have been reduced. Net lease is a net amount that is coming to the landlord or the owner of the property. Industrial real estate includes warehouses, godowns. Again, the performance of this category will be dependent on the overall economy. Retail includes malls, shops, high street shops, etc. The performance of retail real estate as an asset class will depend on consumer spending, the incomes, and normally we've seen that owners get into agreements that have a minimum guaranteed rental plus some share of revenue after the revenue has exceeded a particular percentage. Multifamily commercial property is the same as apartments and residential real estate. However, it has been purchased with the intent of receiving rental rather than staying or rather than capital appreciation. So multifamily property can again be the commercial type if we are primarily deriving lease income. The performance of this asset will depend on the population growth in the surrounding regions and the desirability of people to stay in that apartment or in that colony. So the better it is, the more will be the return, or the higher will be the rent that people will be willing to pay. Now there are various approaches in which we can value real estate. In the cost approach, we try to see the cost of replicating that real estate today, purchasing the land, setting up the building, construction, labor, steel, cement, all costs included. What is the cost of exactly replacing that building today is what the value will be according to the cost approach. In the sales comparison approach, we see or we derive our value from sales that have happened with or of related properties that have happened in the region, and hence compute the value of our property. In the income approach, we try to estimate the income that we can derive from this real estate and give that income a multiple to compute the value of the property. And multiple is called the cap rate, or that income is multiplied by 1 upon the cap rate, as we'll discuss when we see a specific example of the three approaches. An investor is considering a site to build either an office building or a shopping mall. Once construction is complete, the office building would have an estimated value of 60 million euro and the shopping mall would have an estimated value of 52 million euro. Construction cost including developer profit are estimated at 54 million euro for the office building and 44 million euro for the shopping mall. Calculate the highest and the best use of the site. So the highest and best use is the option that makes you derive the maximum value. For the shopping mall, you have a value that is lower. It's only $52 million. However, the construction cost is also significantly lower. It is only 44 million. Hence, giving you a net value of $8 million. For the office building, the value could be higher. It is to the tune of 60 million. However, the cost is also high. It is 54 million, giving us a net value of only 6 million. So the highest and best use in this case will be the shopping mall. In other words, the highest and best use is where the implied land value is the highest. So 60 million is the value when completed and 54 is the construction cost. So the implied land value you can say is $6 million. We are assuming the land is already there. Hence we need to either construct a shopping mall or a office. The implied land value in the office comes out to be 6. The implied land value in the shopping mall comes out to be 8. Hence it gives us more value. It is the project that should be chosen. Now a very important concept in real estate is the net operating income. Now you must remember this calculation and see how it is applied. So net operating income is calculated as the rental income assuming it was fully occupied plus any other income that is expected to come from the property, any additional fees, etc. that is coming over and above the rent. So this will give us the potential gross income. Potential gross income minus vacancy and collection loss will give us the effective gross income. Effective gross income minus the operating expense of the property. Now the operating expense includes utilities and maintenance. It includes the income tax, rather not the not the income tax, it includes the direct tax that or the property tax that needs to be made and the insurance. So only 3 things need to be deducted, that is property taxes and insurance and utilities and maintenance expense. So whatever is the remaining rental will be referred to as the net operating income. Please note, interest, depreciation do not form a part of net operating income. So calculate the rental if fully occupied plus the other income. This will be the potential gross income, its potential, minus vacancy and collection loss will be the effective gross income, minus the operating expenses, that is utilities and maintenance, property tax and insurance, will give us the net operating income. So calculate net operating income using the following information. It is an office building with a size of 350,000 square feet, a gross rental income of 10 euro per square feet, other income of 80,000 euros, vacancy and collection loss of 2% of the gross rental income, guys. The potential gross income can also be written as the gross rental income, and minus vacancy and collection loss will be the effective gross income. Property tax, utilities and maintenance are all given. Interest expense is 440,000 euros and income tax is 30%. Please note, interest expense and income tax will anyways not be a part of NOI. So we'll get the potential gross income as 350,000 into 10, that is $3.5 million, plus 0.08 million is the other income, that is $80,000. 2% of this gross income or potential gross income will be taken away in vacancy and collection loss. So the effective gross income will be equal to 3.58 into 1 minus 0.02, that is 3.5084 million euros will be the effective gross income. From this we need to subtract utilities and maintenance and property taxes and insurance. So another 0.925 million will be reduced, giving us the net operating income as $2.5834 million. The most important use of the net operating income is to calculate the value of the property by dividing it with the cap rate. We studied the Gordon growth model, wherein the next year's dividend was discounted back by KE minus G to compute the value of the property. The cap rate methodology assumes or effectively assumes that this net operating income for the next year is like the dividend that the real estate is giving, and we discount it by the we divide it by the cap rate to compute the value of the property. So cap rate essentially accounts for the discount rate minus the growth rate. So if the property is expected to grow well, rather the rentals are expected to grow well, then the cap rate will be lower. If rentals are not expected to grow, or if they are expected to come down, then the cap rate will be higher. So cap rate is discount rate minus growth rate. A lot of times the cap rate can come from comparable sales. So if a property in the nearby region had a known NOI and it got sold for a particular price, then can we compute the implied cap rate? Implied cap rate will be the NOI divided by the sales price of that comparable property. And then we can value our property by computing the NOI for our property as we just did and dividing it by that cap rate. Assume that net operating income for an office building is expected to be $0.215 million and the cap rate is 5%. Estimate the market value of the property using the direct capitalization method. Too simple, we just need to divide 215,000 by 0.05, that is 5%, and it will give us our answer as $4.3 million. Now sometimes what happens is that the tenant is required to pay all these expenses that we discussed. So the property tax, insurance, utilities, maintenance, all these bills are required to be paid by the tenant himself. In that case, we don't need to compute the NOI. We can just give a discount rate to the rent itself, because rent is practically equal to the NOI. If we are discounting just the rent, the concept remains the same as cap rate. However, the cap rate is then called as the all risks yield. Again, the all risks yield captures the current rates of interest minus the growth rate expected in the rent. So concept is the same. It's just that if all expenses are paid by the tenant, we discount the rent directly, and the cap rate is then called the all risks yield. In the beginning of this year, a renovation began in a hotel. This year NOI is forecasted at 8 million euros. Without renovations, NOI would have been 15 million. After this year, NOI is expected to increase 6% annually. Assuming all renovations are completed by the seller at their expense, not the buyer. You have to complete it. Estimate the value of the hotel to you as the beginning of this year. So you're asked the value at the beginning, assuming the required rate of return is 16%. Now, this year's expected NOI is going to be 8 million. This 8 million will be at the end of the year or at the beginning of the year? The 8 million will come at the end of the year. The stabilized value of this 8 million would have been 8 plus 7, that is $15 million that is given. And this 15 henceforth would have grown at the rate of 6% for t equal to 3 until infinity. Question asked is, what is the value of the property today? To compute the value of the property, we will definitely capitalize the 15 million that is expected to come at the end of this year, and we will capitalize it by KE minus G, that is the fair cap rate, that is the required rate adjusted for the growth. So the value without the complication of renovation would have been 15 divided by 10%, that is 16 minus 6, equal to $150 million. Please note, this 15 is coming at the end of the year. So if we discount this back, if we discount D1 back, then we get the value at t equal to 0. So this 150 million is the value at t equal to 0. However, throughout this year, we will also be required to spend $7 million. Now these $7 million may be spent in the middle of the year, they may be spent at the end of the year. The present value of those $7 million will be slightly less than 7 because we are computing the value at t equal to 0. Let's assume that the 7 are being spent at the end of the year, that we have good terms with the contractor, and once the contractor finishes his work, we make his payment. Right now we've given some minor advance, but the payment is made at the end of the year. That means from 150 we will subtract 7 upon 1.16 to compute our answer. Which comes out to be $143.96 million. So this is the concept of stabilized NOI. That when you are giving the cap rate, or when you are applying the cap rate, you should apply it to the stabilized NOI, which is $15 million in this case. In the NOI method, the cap rate normally comes from comparable properties. That is, the NOI of a comparable property divided by the sales price of a comparable property will give us the cap rate. We can simply calculate, or similarly rather calculate, the gross income multiplier from comparable properties. That is, assuming that costs, that is property insurance, maintenance, is roughly the same for all buildings. If one building had a gross income of $100 million and a sales price of $1,000 million, then the gross income multiplier comes out to be 10 times. That is the sales price upon the gross income. And then the value of our real estate or our building can be calculated as the potential gross income from our building multiplied by the gross income multiplier. Because of existing leases, the NOI of a building is expected to be $4 million per year over the next 3 years. Beginning in 4th year, the NOI is expected to increase to $6 million. Probably the rent will get revised and grow at 6% annually thereafter. So the 4th year's NOI is 6 and the 5th will be 6 into 1.06. Assuming investors require a 12% return, calculate the value of the property today, assuming the building is sold after 3 years. So from t equal to 4, we can apply the cap rate and calculate the value at t equal to 3. That will come out to be 6 divided by 0.12 minus 0.06, which will come out to be $100 million. And now we can use the TVM sheet directly by entering N as 3, PMT as 4, I by Y as 12, FE as 100, and compute PV to calculate the value of the property, which comes out to be $80.7 million. Please note, if these cash flows were not exactly the same and this value is not 100, we maybe would have needed the cash flow sheet to solve these questions. A warehouse was leased 10 years ago at £150,000 per year. The next periodic rent review is due in 3 years. The estimated rental value in 3 years based on current market conditions is £2,000 per year. The all risks yield for comparable fully let properties is 9%, that is K minus G, where the required return is 15% and the expected growth is 6%, giving us an all risks yield of 9%. Because of lower risk, the appropriate rate to discount the term rent, that is for the next 3 years, is 7%. Estimate the value of the warehouse. So again, let's first draw the timeline. For t equal to 1, 2 and 3, we get a rent of £150,000. So we just write 150,000. From t equal to 4 onwards, we start getting 200,000 pounds. However, the risk increases because it is not a very low rent. If economy goes bad, this can again come down. This 150 is very low risk, so it is discounted back at the rate of 7% that is given. The cap rate applicable to this 200k is 9%. So it's coming from t equal to 4. So 200 upon 0.09 will be the value at t equal to 3. Now please note that these cash flows are not low risk, or they are not as low risk as these 150k, so they cannot be clubbed together. This will have to be separately discounted back to t equal to 0 at the rate of 15%, that is the discount rate. So we will further discount this back by 1.15 to the power 3. Summing the two up will give us the answer. So let's do n as 3, PMT as 150, I by y as 7, FV as 0, and compute PV. This will give us the present value of the term rent. The value of the revised rentals after capitalization comes out to be 2.22 million. Discounted back at the rate of 15% for 3 years will give us a value of approximately $1.46 million. So we'll add this to our PV, which comes out to be 0.39 million, to give us the final answer as 1.46 plus 0.39, that is $1.85 million. Continuing the previous example of the term and reversion valuation approach, assume the contract rent is capitalized at 10% and the incremental rent is capitalized at 12%. The discount rate remains 15%. So this 150 that is fixed. To compute the value at t equal to 0, we will simply capitalize it at the rate of 10%. So the value will simply come out to be 1.5 million pounds. It was 150,000. This divided by 0.1 will be 1.5 million pounds. The 50,000 incremental that has started to come from t equal to 4 will be capitalized at the rate of 12%, or this value at t equal to 3 1 year back would be 50 upon 0.12, that is $0.417 million pounds. We need to further discount this back 3 years at a discount rate of 15%, so that will be 1.15 to the power 3, which will give us the value at t equal to 0 as approximately 0.274 million, or the total value would be 1.5 plus 0.274, that is $1.774 million using the layer method. The earlier was referred to as the term and reversion valuation approach. So the term rent is lower, it will revert to 200,000. That was term and reversion. The term is discounted separately and the reversion is discounted separately. In the layer method, we apply a different cap rate to the low layer or the term layer and a higher cap rate to the incremental layer, basically accounting for the higher risk of this 50,000. We could have also used a full-blown DCF method to value the property, wherein we would first be required to project the income from existing leases, have some assumptions from lease renewal and incorporate those in our cash flows in the future, make some operating expense assumptions, some capital expenditure assumptions, vacancy assumptions, estimate the resale price at some point, that is 3 or 4 years down the line. So for 3 or 4 years or 5 years, we will explicitly project each of these items: the income, renewals, expenses, capital expenditures, vacancy. Thereafter, we will assume a resale price that we will be able to achieve, calculate an appropriate discount rate and discount the cash flows back to compute the value of the property. Total operating expenses for a commercial building having multiple MNCs as tenants are 40% fixed and 60% variable. If the 50,000 square foot building was fully occupied, the operating expenses would total $5 per square foot. The building is currently 85% occupied. If the total operating expenses are allocated to the occupied space, calculate the operating expense per occupied square foot. First, let's try to calculate the total expense assuming the building was fully occupied in dollar terms. That will come out to be 5 into 50,000, that is equal to $250,000. Out of this 250,000, 40% is fixed and 60% is variable, or even after this of this $5, 40% is fixed and 60% is variable. So 40% of 250,000 would be 100,000, and 60% of the 250,000 would be 150,000. Now we cannot allocate these expenses to the entire 50,000 square feet. So a part of it will remain separate, but the 40,000 fixed expenses that we were allocating would be allocated to only 85% of the space now. So 85% of 50,000, 42,500. So this 100,000 will be allocated to only 42,500 square feet of area, making the per square feet cost as 100,000 divided by 42,500, that is the fixed cost, equal to 2.35. The variable cost is variable, so that will still be allocated to 50,000 square feet. If the square feet reduces, this cost will also correspondingly reduce. So the variable cost per square foot will still remain the same, that is 3 rupees or 3 pounds, 60% of 5, or you can do 150 divided by 50. Either ways it is $3 per square foot. So the total per square feet cost, if it is only 85% occupied, will become 5 or 3 plus 2.35, that is $5.35 per square foot. Please note, variable cost remains the same. It is anyways variable. If the square footage reduces, that cost will also reduce. Problem is the fixed cost. If the square footage occupied reduces, the fixed cost still remain the same. Hence the existing people will have to pay more, or the existing tenants should need to pay more if they have to recover the entire fixed cost. So the total cost per square foot becomes $5.35. So that's about the beginning of private real estate investments. We'll carry on with the discussion in the coming sessions. Thanks a lot and see you next time.